and good evening to everyone. Welcome to Unacademy IAS. This is Shyam Kaggod here. Before I start the session, please do let me know, am I audible and visible for everyone? Those who are present in the session, please do give me the confirmation. I'm looking at the chat section, by the way. Am I audible and visible for everyone? Done then. Let's start. So welcome to another session in the new initiative, Fundamentals of Indian Economy. And in today's session, the initiative which was launched on Monday, today will be the last session. So in this session, I'll be taking care of a very important concept, that is exchange rate and balance of payments. They will also use the short form of this BOP, balance of payments. So these are the two very important concepts that I'll be discussing in today's session. Before I start, as usual, those who want to download the PPT and want to get the handout, that is the notes of this particular session, this is the QR code of my Telegram channel. Do join it. And once the session is over, the PPT as well as the PDF of the notes will be uploaded in my Telegram channel. And a lot of you who are preparing for the civil services exams 26 and 27, you need certain guidance, you need certain strategy, you need certain motivation. For all of this, we are conducting an Unacademy UPSC Summit on 5th as well as the 6th July 2025. You will get to listen to a lot of these bureaucrats who have vast wealth of experience. You can get a chance to listen to top educators, etc. Please do join the sessions live, and for that all you need to do is register for the session. The link for the registration is provided in the description below. Do check out, register and attend the sessions live. And if you're let's say wondering, sir, will you also be taking a live session? Sunday 6th of May, Sunday 6 p.m. I'll be taking a live session where I'll be talking about what kind of strategy you can follow to clear or get very good number of marks from the subject of Indian economy in the prelims, mains 26 and 27. How can you make notes? What kind of news articles you're supposed to read, right? Basically the revision strategy, references, etc. So those who are interested, note down the timing, Sunday 6th of May, 6 p.m. My session will be there. Right, done. Let me start the discussion then. So the two concepts I'll be discussing will be one, exchange rate. Let me start with the first one, exchange rate. Then we can enter into the idea of a balance of payments. Now, what is this idea of an exchange rate? Listen to me carefully now. There is a term called as open economy. All of you heard of this particular term? Please do let me know in the chat section. There is a term called as open economy. What is the meaning of the term open economy? Whenever one country, whenever a particular country has multiple transactions with rest of the world, when one country has multiple types of transactions with rest of the world, we call this economy as an open economy. Now, what do you mean by transactions here? Let's say the country is India. Imagine this is India and this is the rest of the world. From India, the goods will be exported. From India, the services would be exported. From India, let's say labor will migrate to, let's say Middle East. And in the same way, from rest of the world, investments will come to India. From rest of the world, labor will come to India. From rest of the world, goods and services will come to India. So is everybody able to understand the argument of transactions here? There are multiple types of transactions which will take place between one country and the rest of the world. And that system, we call it as open economy. Please remember, India is the best example of open economy. USA, Japan, Germany, China, right? These are the examples of open economy. Now, this is point number one. Now, let's go to the point number two. Whenever there is an open economy, don't you think because of multiple transactions, there will be a need to convert, let's say, rupee to dollar and dollar to rupee? I'll repeat the statement. Because we follow an open economy, let's say imports will come to India. When imports will come to India, can you use rupees to directly make a payment to the exporter sitting in USA. Rupee is a domestic currency. Why will an exporter sitting in USA accept payment in the form of rupee? They will simply say, we don't want rupee, please give me the payment in terms of dollars. Same thing will happen to us also. They will make a payment in terms of dollars. Can I use dollars to make payments of salaries of my employees? Can I take the dollar, go to the market, try to purchase raw materials in India? Can I use the dollars to repay the loans that I've taken from a bank, etc.? They will not be accepting it. Reason being, rupee is the domestic currency. I need to convert the dollar into rupee. So argument is very simple here. Because of multiple transactions, there will be a requirement to convert domestic currency to foreign currency and foreign currency to domestic currency. And this will happen in a market called as Forex market. Please remember the name. This will happen in a market called as Forex market. Forex is a short form of two words, foreign exchange. Forex is a combination of two words, foreign exchange. So in the Forex market, domestic currency is converted into foreign currency and foreign currency is converted into domestic currency. For example, many of you will ask me, sir, where is the Forex market available? I know vegetable market is there in my place. I can see vegetable market is there, wholesale market is there. But where is the Forex market? My dear, please understand this. When I use the term Forex market, essentially there are different participants in the Forex market. For example, all of you heard of Western Union? Do let me know. All of you heard of, right, let's say Thomas Cook? All of you heard of, let's say State Bank of India, ICICI Bank for that matter? You can approach any of these, right, let's say participants in the market, and there is a particular process, right? Complete the process, that is the documentation work is there. Complete the documentation work. Now you can pay rupees, in return get dollars. If you have dollars, submit the dollars, in return you will get rupees. So when I say Forex market, do not imagine there is literally a market in every village, every city like this, where you can go, right, enter the gate, etc. No, you can approach banks, you can approach multiple financial institutions, right, tourist operators, or even for that matter, right, multiple money exchanges. They will provide you the facility of conversion of domestic currency into foreign and foreign currency into domestic currency. But all of them essentially will get the right of this, will get the approval to conduct all of this from Reserve Bank of India. Please remember this. It is the Reserve Bank of India which is the manager, which is the custodian of the Forex reserves. I will repeat the statement. Please remember this. It is the Reserve Bank of India which is the custodian, which is the manager of Forex reserves. That is, whatever foreign currencies come into India or whatever foreign currencies go out of India, all of this essentially is managed, comes under the supervision of Reserve Bank of India. Remember this particular point. This is important. Please remember this. Now, we have understood the basic of Forex market. We have understood the basic idea of a Forex market. Everybody is okay with the discussion so far? Please do let me know in the chat section. I want everybody to participate. Do let me know. Now the question arises, how do we arrive at exchange rate? How do we arrive at exchange rate? For example, when you read the newspaper, they'll simply say $1 is equal to 86 rupees. Correct? They'll say $1 is equal to 87. $1 was 65 earlier. $1 was, right, let's say 52 earlier. Question is, on what basis do we arrive at this exchange rate? On what basis? Broadly, there are two types. Remember this, I'll go one after the other. Broadly, there are two types. One is called as a fixed exchange rate. Fixed exchange rate. I'm using ER. What is ER? Exchange rate. I know a lot of you who watch web series, especially let's say English web series, they'll simply look at the term ER and say, right, emergency room, right, not emergency room, exchange rate. So broadly, under the exchange rate, there are two types. One is called as a fixed exchange rate. Different names are there. For example, you might come across the term pegged exchange rate. PEGGED. Pegged exchange rate. Okay. And the other one is floating exchange rate. The other one is floating exchange rate. Broadly two types. But please understand, there is one more type as well, which is called as managed exchange rate. I will come to this in some time, do not worry. The third one is managed exchange rate. Fixed, floating and managed. Now, what is the basic idea of a fixed exchange rate? In fixed exchange rate, the government will determine what will be the exchange rate. Simple. I'll repeat the statement here. When you say fixed exchange rate, the government will determine what is the exchange rate. For example, Government of India, imagine it is not followed in India. Earlier, different countries used to follow it. Today, we do not follow it. Imagine the Government of India decides that $1 is equal to 50 rupees. Just imagine this. Now, all the time, we will try to maintain this exchange rate in the market. Right? Whatever be the supply, whatever be the demand, etc., doesn't matter. We will try to have this kind of exchange rate in the market. Right? So here, who is determining the exchange rate? The Government of India. Right? So whenever the governments determine the exchange rate, we call this as a fixed exchange rate. Now, I said, whatever be the supply or demand for the currencies in the market. What is the meaning of that statement? Just give me 1 minute. I will explain floating exchange rate, then automatically you will understand what did I mean by supply and demand. Listen to me carefully. Let me explain this, then I'll make you understand this as well. There is one more type called as a floating exchange rate. What do you mean by floating exchange rate? Under the floating exchange rate, the supply and demand for the currencies, supply and demand for the currencies will determine what is the exchange rate. Right? What is the exchange rate? Who will determine it? The supply and demand for the currencies. Now, how? Let me explain that with a very simple example. Now, I want everybody to participate and tell me the answer. You tell me, if the supply of onion increases, onion, however you want to pronounce it, doesn't matter. You should understand that I'm talking about onion only. Okay. So, the supply of onion in the market increases. You tell me what will happen to the market price of the onion. Tell me. If the supply increases, what do you think will happen to the price or the value of the onion? Everybody will accept this argument. The price of the onion or the value of the onion in the market should go down. And on the other side, if the demand for the onion increases, if there is very huge demand for the onion, can I simply say, in that case, the price for the onion or the value of the onion will start increasing, going upwards? Everybody is okay with the argument here? Simple concept. I'm not complicating, nothing complicated, nothing technical. If the supply increases, prices will go down. If the demand goes up, prices will go up. Simple logic. Now apply the same logic. Apply the same logic in the forex market. Imagine there is too much supply of rupee. Think of it now. I want you to imagine this. Imagine there is too much of supply of rupee in the market. Now, when you talk about supply of rupee in the forex market, I'm talking about forex market, by the way. What do you mean by forex market here? I will sell rupees and purchase dollars. Is everybody able to understand? I am selling rupees and purchasing dollars. That is exchange. I'm in a forex market. So now tell me, if supply of rupee goes up, is it okay if I say in the forex market, the rupee value should go down? And because it is a forex market, I will sell rupees, purchase dollars. It also means demand for the dollar is going upwards. Now do let me know, is it okay if I say in this situation, rupee value should go down, dollar value should go up. Everybody is okay with my statement? I'll repeat it again and do let me know in the chat section. In this case, when the supply of rupee increases, the value of rupee against the dollar should go down because supply is increasing. And because it's an exchange rate, I will sell rupees, I will in return purchase dollars. The demand for the dollar is going upwards, so the value of dollar should go upwards. Everybody is okay? How can I represent it? How can I write it? Imagine the exchange rate was $1 is equal to 50 rupees. Imagine, okay? Imagine $1 is equal to 50 rupees. Now, because of higher supply of rupees and higher demand for dollar, exchange rate might become $1 is equal to 60 rupees. Now, have a look at this. Can I simply say, from here to here, the value of rupee has gone down. Value. Please do not look at volume. Do not look at volume and get confused. Value of rupee has gone down. Value of a dollar has gone up. Now, everybody is able to understand the price, that is in the exchange rate market here. What is the value of the currency is being determined by supply and demand for the currencies. Government is not determining this. Who is determining it? The supply and demand of the currencies in the market will determine what is the value of exchange rate. Everybody is okay? Please do let me know. Everybody is okay? This is called as floating exchange rate. This is called as floating exchange rate. Right? Everybody is okay? Please do let me know. Nobody is replying. Do reply. At least give me a confirmation that you are understanding. I should understand that you are understanding. So do let me know in the chat section. Everybody is clear? One is a fixed exchange rate where government will fix, not the market. Government will fix. Government will simply say $1 is equal to 50 rupees. That's it. Now what will happen? I'll come to that. But let me finish the floating. In case of floating, supply and demand forces in the market will determine what is the exchange rate. If there is excess supply of rupees, it simply means people, right? Let's say companies, investors, etc. They are selling the rupees, they are purchasing dollars. So value of dollar should go up, value of rupee should go down. And imagine if there is too much of supply of dollars. Sir, any example? My dear, imagine foreign companies will come into India and they want to invest in India. Simple. The foreign companies, a lot of them are coming to India. They want to invest in India. Can I simply say here, the foreign companies are bringing dollars into India? Correct? They are bringing dollars in India. Can they invest directly the dollars? No. What they have to do is sell the dollars, purchase rupees. In this case, in this situation, what will happen? Dollars supply will increase, value should go down. Demand for rupees will increase, value of rupee should go upwards. Exactly opposite of this. Right? Exactly opposite of this. From $1 is equal to 60, now it might become $1 is equal to 50 rupees. Done? Now come to the technical terms. There are two terms here. One is appreciation and the other one is depreciation. One is appreciation, the second one is depreciation. What is the meaning of the term appreciation and depreciation? Whenever in the forex market, whenever you talk about floating exchange rate, value of one currency will go upwards. We say it is appreciating. Simple. Value of one currency against another currency, if the value goes up, we use the term appreciation. And if another currency, if the currency value, one of the values of the currency, if it will go up, the other currency's value should go down. Right? It's basically an exchange rate. If value of one currency goes up, the other currency's value should go down. So this currency whose value has gone down, we use the term depreciation. Is everybody okay with the term appreciation and depreciation? Please do let me know. For example, I want you to answer now. Imagine today, this is the exchange rate. $1 is equal to 50 rupees. And tomorrow, just hypothetical example, tomorrow the exchange rate will be $1 is equal to 40 rupees. Now tell me, if the exchange rate is shifting like this, which of the two currency has depreciated? Tell me the answer. Which of the two currencies have depreciated? I am talking about depreciation first. Which of the two currency has depreciated? Tell me the answer. All of you worried about rupee only. I am talking about depreciation. Which of the two currency has depreciated? All of you will agree? Dollar has experienced depreciation. Correct? Dollar has experienced depreciation. Right? Some of you will be confused here also. My dear, $1 is equal to 50. If $1 becomes 40 rupees, you are paying lesser rupees to get the same dollar. You are paying lesser number of rupees to get the same dollar, which means rupee has become stronger, dollar has become weaker. So dollar has depreciated and the rupee has appreciated. Everybody is okay with the concept of appreciation, depreciation. Now let me connect it to the concept of the fixed exchange rate. Let me come to the concept of fixed exchange rate. What is the connection here? Connection is simple. Imagine the government of India has announced $1 is equal to 50 rupees. Listen to me carefully. Imagine government of India has announced $1 is equal to 50 rupees. Now, don't you think because of dollars coming in, dollars going outside India, right? Rupees being converted into dollars, dollars being converted into rupees, because of these, exchange rate might move away from this one. Exchange rate might move away from this. Instead of being $1 is equal to 50, it can become $1 is equal to 53. It can also become $1 is equal to 45. But listen to me carefully. Under fixed exchange rate, because the dollar to rupee value is moving against or moving away from what was fixed by the government, now there will be certain transactions conducted in order to move the exchange rate towards this. I'll give you example. Listen first. The government has announced this should be the exchange rate. But imagine, I'll just give you an example. Imagine there is too much of supply of rupees. I'll write it here. Imagine there is too much of supply of rupees. If supply of rupee increases, automatically instead of $1 being equal to 50, can it now become $1 is equal to 55 rupees? Can it become? Yes. But the government of India has announced it should be $1 is equal to 50. So what will happen now? What will happen? Reserve Bank of India, please remember this. Reserve Bank of India will try to intervene in the market. RBI will participate in the market. What will RBI do? RBI simply will do what is happening in the market, exactly opposite of that. I'll repeat it. What is the role of RBI in this case? RBI will conduct a transaction which is exactly opposite of what is happening in the market. What is happening in the market? Supply of rupees increasing. RBI will start purchasing rupees. How? RBI will sell dollar. RBI will start purchasing rupees. Now tell me, if RBI will start taking out rupees from the supply, increase the supply of dollar, don't you think this exchange rate, instead of staying at $1 is equal to 55, will move towards this exchange rate? Correct or not? Instead of saying at $1 is equal to 55 rupees, now supply of dollar will increase. Demand for rupee will increase because of RBI. Don't you think exchange rate will start moving towards what was decided by Government of India? So that is how we will ensure that this exchange rate will be present in the market. This is how right? The central banks or the governments across the world, which earlier used to follow the concept of fixed exchange rate, used to ensure this will be the exchange rate that will be present in the market. Whatever might be the supply or the demand for the currencies, they will intervene and they will try to move the exchange rate towards whatever was fixed by the government there. Everybody is able to understand the difference between, right, let's say the fixed exchange rate and the floating exchange rate. And remember, in the context of the fixed exchange rate, the technical terms used are essentially devaluation and revaluation. The technical terms used are devaluation and revaluation, equivalent to the same idea. Revaluation means one currency against another currency. Now, because of the fixed exchange rate, the value will go up. If the government will intervene in the market, right, basically push up the value of one currency against another currency, we will use the term revaluation. Devaluation means reduce the value, right? Basically, reduce the value of the domestic currency against the foreign currency. But because this is being done by the government, these are associated with fixed exchange rate. And because it is done by the market forces, it will be part of floating exchange rate. Done? So far so good? The story is okay with everybody here? Story is okay with everyone? Now, most of the countries neither follow purely the fixed exchange rate or floating exchange rate. They follow a variety of it, which is called as a managed exchange rate. They basically follow a variety, a mixture of both of them, which is called as managed exchange rate. What happens in a managed exchange rate? Listen to me carefully. In the managed exchange rate, for example, which is followed by India. India follows managed exchange rate. In the managed exchange rate, we will allow the market forces to determine the exchange rate. The supply of currencies is going to change. Demand for the currencies is going to change because of imports, exports, investments coming in, investments going out, etc. We will allow the market forces to determine the exchange rate. But please understand, if there is a sudden change in the value of the Indian currency, that is, if there is a sudden appreciation, sudden depreciation of the domestic currency, that is the Indian rupee, RBI will intervene in the market. Right? I'll repeat the statement. If there is a very fast appreciation of rupee, what is the meaning of it? Supply of dollar is increasing, demand for the rupee is increasing. Too much demand for rupee. That's the reason rupee is appreciating. Can we allow uncontrolled appreciation or uncontrolled depreciation of the currency? Not good for India. Please remember this. Right? Whether it is uncontrolled appreciation or uncontrolled depreciation, not at all good for India. I'll give an example. Some of you might be thinking why it is not good. I'll just tell you one example. Listen to me carefully. If there is uncontrolled depreciation, you tell me what was valued, that is Indian rupee. I'll come to the question, don't worry. Imagine Indian rupee value was $1 is equal to 60 rupees. It goes up to $1 is equal to 80 rupees. Very high depreciation. Now tell me, will this not have a huge impact on imports which will happen into India? Think of this and let me know the answer. Don't you think this will have a very high impact on the imports which are going to come into India? Right? Because India is a net importer. If you import something, rather than paying 60 rupees for every dollar, now you will have to pay 80 rupees per dollar. You will have to pay high amount of money in terms of rupees now. That will have a huge impact on India. Uncontrolled depreciation, not good. Now I know some of you look at it and say, in that case, appreciation will be good. Your argument will be, sir, in that case, appreciation will be good for India. No, I'll explain that also. Imagine $1 is equal to 60 rupees. $1 will become, let's say, 40 rupees. Very high appreciation of Indian rupee. Now tell me, if you are an exporter, will you prefer this? Let me know now. If you are an exporter, Will you prefer this? If you simply say yes sir, my dear, you are making a big mistake in terms of exports. Why? Yesterday you exported, you got $1. You got it converted into rupees, which will fetch you 60 rupees. Today you exported, you received $1. You will exchange that with rupees, you will get how much? 40 rupees. Is it okay? You will get 40 rupees. So don't you think if you wanted to earn 60 rupees at this exchange rate, you will price your export at $1.50. Correct? All of you able to understand? At this exchange rate, you will price your product at $1.50. And if you price, that is, if you basically say your export will be $1.50 now, your export will become less competitive. Right? From USA, they'll simply say, I will purchase from China. Why should I purchase from India? It is very costly now. I'll purchase it from somebody else. So your competitiveness of exports will be affected. So everybody is able to understand? Again, right, lot of discussion can be had here. But is the logic okay? Uncontrolled appreciation, not good. Uncontrolled depreciation, not good. That is the reason whenever there is a very sudden appreciation or depreciation of the domestic currency, RBI will intervene in the market. RBI will intervene. What do you mean by intervening here? If there is very high appreciation of rupee, means demand for the rupee is very high, RBI will supply rupees in the market. If there is a very fast depreciation of Indian rupee, it also means rupee supply is very high. RBI will start purchasing the rupees. Purchase rupees and pay in dollar. Right? So thereby ensuring that whatever is the sudden appreciation, sudden depreciation, that will be controlled. And this method is essentially referred to as managed exchange rate. Is everybody okay with the statement here? Please do let me know. This methodology is referred to as managed exchange rate, and post 1993 the government of India has introduced, RBI has introduced managed exchange rate in India. Post 1993, that is specifically, sir, some of you might be thinking, what is the importance of 1993? All of you please remember this, 1991 year is very important. Why? We implemented LPG reforms, liberalization, privatization and globalization reforms. 1991 is a very important year for that. And right, let's say in these particular years, multiple reforms were implemented in industries, in exchange rate, in licensing norms, right, etc., etc. One of the reform was essentially shift to a floating exchange rate. Shift to a floating exchange rate. Everybody is okay with the discussion so far? Let's solve an MCQ. All of you, please solve the MCQ. Before I tell you the answer, I want an answer from your side. Let's start. Consider the following statements. The forex reserves are managed by Reserve Bank of India. RBI manages the forex reserves. Second statement, India has been following managed floating exchange rate from 1993. Third statement, India is the largest recipient of inward remittances. First statement is correct. What about the second statement? Yes. From 1993, India shifted to the concept of floating exchange rate. Okay. And the third one, India is the largest recipient of inward remittances. Yes, this statement is also correct. What is happening? This statement is also correct. All the three statements are correct. For example, do let me know how many of you were able to watch the Economy This Week video that was uploaded today. Let me know. It was uploaded at 6 p.m. today. 6 p.m. today. That is essentially we have covered multiple articles. One of the articles that I have covered today is essentially associated with the forex reserves. That is the inflow of currencies, inflow of dollars. India last year has received, remember this data, $135 billion remittances. Remittances essentially means inflow of currencies. For what purpose? Right? Let's say you will send the money to take care of your parents. You will send money for gift purposes into India. You will send money to your siblings, right? Your spouse, your children. That is called as remittances. Transfer of funds from external market into India, foreign remittances. Is the term okay with all of you? I'm explaining this because a lot of you will feel remittances means from outside India into India. You will feel only this is remittances. Please no. Remittance is a very common term. It's a very common term. Whenever you transfer funds from one side to another side, it is called as a remittance. Within the domestic market also, you can have remittances. But India is the first country or the largest country in terms of receiving inward remittances. Inward remittances means from outside India into India. That is inward remittances. So according to the latest data, we have received $135 billion, the largest in the world. Is it okay? Largest in the world. Third statement is also correct. So all the three statements are correct. Right option is option D, 1, 2 and 3. Now let me continue the discussion. Right, one MCQ is done. Let me continue the discussion. So far what we have discussed, what is exchange rate? What is the need to have exchange rate? Right? What are the different types of exchange rate? And what are the different types? Somebody else was asking, sir, any country which follows a fixed exchange rate? Purely they don't follow, but a version of fixed exchange rate they follow. For example, I told you there is a term called as a pegged exchange rate. Pegged, P-E-G-G-E-D. China is generally following the pegged exchange rate, which is a version of fixed exchange rate only. Done? And that's the reason very often you will come across this statement. Do let me know now, at least now, does the current affairs statement make sense to you? There is very often an allegation that China devalues its currency. Is my statement okay with all of you? A lot of times you will come across this statement in the newspaper. There is very often an allegation that China is involved in the devaluation of its currency. Why are they using the term devaluation? Because the government there through the central bank tries to drag back the exchange rate to a particular level. They have fixed that particular level. They will try to drag it back to that level. In case of India, does RBI intervene? Yes. But please listen to me carefully. Some of you will say, in that case, what is the difference between China and India? In China, they have decided what should be the exchange rate. In India, we do not decide. We simply want to stabilize exchange rate. Is everybody okay with my statement? Remember this, write this only. In India, we have not decided what should be the exchange rate. If there is a sudden appreciation, we will stabilize it. If there is a sudden depreciation, we will stabilize it. So focus in India is on stabilization of exchange rate, not dragging the exchange rate to a particular level, which is done by China. Everybody is okay? Now, next, what are the factors influencing exchange rate? What are the different factors which will influence exchange rate? At the first and foremost, listen to me carefully now. The first factor which will influence the exchange rate is, right, let's say the imports and exports. The imports and exports. How? If there is a huge amount of imports coming into India, now you will have to make a payment in terms of dollars. If you want to make a payment in terms of dollars, you will have to sell rupees. Supply of rupee goes up, you will demand dollars, demand for dollar goes up. Everybody is able to understand? In the same way, exports. You will export, you will receive payment in dollar. You will go to the forex market, you will sell the dollar, supply of dollar goes up. You will purchase rupees, demand for the rupees goes up. So essentially, everything boils down to supply and demand. Right? So imports, exports. Second factor, interest rate. I'm using the term interest rate. Many of the times, instead of the term interest rate, they can use the term monetary policy. Interest rate or monetary policy. Right? How? How interest rate will influence exchange rate? You tell me, I want answer from everybody. You are a foreign investor. You're a foreign investor. In country A, for investing, you will get, let's say, 6% rate of interest. You will invest and you will earn 6% rate of interest. In country B, now they will offer 7% rate of interest. You invest 100 rupees in your country, you will get 7% rate of interest. Now tell me, will you not shift your investments from country A to country B? Yes or no? Will you not shift your investments from country A to country B? Why? My dear, the country which will offer a higher rate of interest, will you not be interested in that? Don't you want to earn a higher amount of, right, let's say interest? Of course, yes. So now tell me, if dollars will come, imagine this is India. Understand this. Imagine this is India. If dollars will come into India because of higher interest rate, will this not influence exchange rate? Correct? Will this not influence exchange rate in India? Yes, it will influence exchange rate. Now, I hope you understand. Can country A also do the same thing? Can the country A also do the same thing? Yes. USA very recently increased its interest rates. USA, that is the central banker in USA, increased its interest rates. Now, if you are an investor who has shifted from USA to India, that is investments, with USA increasing interest rate, what will you do? You will move your investment from India to USA. That has happened very recently. Correct? That has happened very recently. Right? So I hope you understand the interest rates will also influence exchange rate, because the foreign investors will keep on moving from one country to another country in search of higher interest rates. Higher interest rates. They will do that, and that will influence exchange rate. Now, third factor, speculation. Third factor, speculation. Important one, will connect it to current affairs. What is speculation? Think of this. What is speculation? Speculation simply is a guess. Based on certain factors, your mind will say something. That is called as speculation. Is it okay? You're making a guess. You're taking a guess, but not blindly. Based on certain factors, you are assuming this will happen. This will happen tomorrow. This will happen, right, day after tomorrow. Right? You're taking a guess. That is called as speculation. For example, you tell me, if Israel and Iran will go to the next level in terms of attacking each other, what do you think will happen to the crude oil prices? Let me know. If Israel and Iran and the USA also jumps in, starts participating, starts bombarding Iran to the next level, other allies of Iran will also jump into this particular war, what do you think will happen to the crude oil prices? All of you will agree? Even before it will happen, you can speculate it. Correct or not? Even before the actual prices will start increasing, can you speculate it? Can you take a call based on factors? Can you guess in what way the prices will move? That is speculation. Everybody is able to understand? That is called as speculation. You are making a guess regarding the movement in the market. Now that will also influence a lot of outflow of money and inflow of money. It will lead to either outflow or inflow of money. Done? Right? So speculation. What about government expenditure? Think of this. Government expenditure. Will the government expenditure influence exchange rate? Answer is yes. How so? Listen to me carefully. Whichever country experiences a higher rate of inflation, I repeat, whichever country experiences a higher rate of inflation, generally right, that country's currency loses value. I'll tell you how, but listen first. Whichever country experiences a higher rate of inflation, generally that country's currency starts losing value. How so? If in India the inflation rate is very high, you tell me, don't you think the exports will become very costlier? Yes or no? From India, whatever exports you want to send now, because of inflation, don't you think the market price would be much higher? If the market prices are much higher, exports will start losing competitiveness. What can happen to imports? Imports might end up becoming cheaper. Everybody is able to understand the connection here, right? So inflation will have an influence on the exchange rate, and the exports might start losing competitiveness, imports might start increasing, and that will influence exchange rate, where the domestic currency will start losing value. Now, next important point, government expenditure is connected to inflation. Remember this. The government expenditure is connected to inflation. How so? Whenever government spends money, expenditure is very high. Don't you think government will increase money supply in the economy? I want an answer from all of you. Tell me now. We have discussed this, right? Earlier also we have discussed this, but in a different way. If government of India will start spending too much amount of money, don't you think money supply in the economy increases? And if the money supply in the economy increases, will this not contribute to demand pull inflation? Correct? Will this not contribute, right, in the form of demand pull inflation? Yes. And we have already understood, if inflation will happen, it will influence exchange rate. So government expenditure is connected to inflation. Inflation is already connected to the exchange rate. So these are the various factors which will influence the exchange rate. These are the various factors which will influence exchange rate. Everybody is okay with the discussion so far? Based on this, I have given a question. Solve it. Quickly solve the question. Right? What is the question? Under which of the following circumstances the Indian rupee will depreciate? Under which of the following circumstances the Indian rupee depreciates? Higher FPI inflows into the stock market, higher interest rates in USA, higher crude oil prices. Let's start one after the other. Right? Those who have solved, please do let me know the answer in the chat section. Christopher says option C is the right one. Others? Lucy Parveen, option B. Chirag, option D. So D has been opted, C has been opted. Right? Somebody earlier said B also. Somebody say A, so that we will have the whole spectrum of answers. Somebody A, some say B, some say C, and some will say D. There is a very famous saying in the context of India. Anekata mein ekata, Bharat ki visheshata. Right there, that is very much evident in terms of, let's say, the key answers you people are providing. Right? All the options A, B, C, and D. Let's solve it. Higher FPI inflows into India's stock market. Higher FPI will come into India. FPI simply means foreign investments. Now, right, have a look at this. If foreign investments will come into India, don't you think demand for the rupee will increase? Correct? Demand for the Indian rupee will increase. Why? Foreign investors will bring dollar. They will sell the dollar, purchase the rupees, because they want to invest in India's stock market. So obviously this will lead to appreciation of Indian rupee. Yes or no? Do let me know in the chat section, yes or no. Right? It will lead to appreciation of Indian rupee. Higher interest rates in USA. I've told you this. If USA will start offering higher interest rate, lot of foreign investors will take their money from India, sell the rupees, convert them into dollars, take the dollars, run back to USA. That will lead to what? Rupee depreciation. Rupee depreciation. Yes, this will lead to rupee depreciation. Higher crude oil prices. If crude oil prices will go upwards, For purchasing the same amount of crude now, I will have to sell more rupees. I will have to pay more rupees. If I pay more rupees, supply of rupees increases. And when the supply of rupee increases, it will lead to depreciation of Indian rupee. Correct? Everybody is okay with the options here. So second and third is correct. Right option for the question will be option C, 2 and 3. Can I move forward now? Everybody is okay with the discussion. Can I move forward? Right. So right option is right, the second statement as well as the third statement. Now, associated with the concept of exchange rate, Tejpal Sim, my dear, I'll come to your right doubt. I'll address your doubt. Don't worry. Let me cover the concepts first. At the end of the session, I'll address all of your doubts. Now, let's start. Balance of payments. Second concept for today. What do you mean by balance of payments? Listen to me carefully. Balance of payments essentially is a record. It is the record of all import transactions and export transactions. I'll repeat the statement here. What is the balance of payment? It is a record of all the import transaction. Import transaction means what? Whatever transaction will lead to inflow of dollars into India. And export transaction, whatever dollars will lead to outflow of dollars from India. There are multiple transactions. I hope you remember I started with that idea itself, open economy. There are multiple transactions between India and rest of the world. Because of these transactions, dollars will come into India, dollars will go out of India. All of these transactions are recorded and that is called as balance of payments. Everybody is okay with the definition? Who will prepare the record? It is the Reserve Bank of India, RBI, which is responsible for the preparation of balance of payments. In India, it is the Reserve Bank of India which will prepare the list of all the transactions leading to inflow of dollar as well as outflow of dollar. And that is called as balance of payments. Let me show you a very simplified version of it. Please have a look at this, a simplified version. Don't complicate this. You do not have to memorize the complete detailed balance of payment because RBI publishes balance of payment which is 3 pages. Right, all of you able to understand? It is of 3 pages. You do not have to remember the complete list. Simplify. Simplified version is 1. There is a current account. There is a capital account. What is a current and capital account? The transactions which are generally associated with the assets or liabilities, these are kept under the capital account. Is my statement clear to everyone? Please do let me know. Most of you have stopped, right? Let's say replying to my questions now. Do let me know. I know dinner time, I know movie time, I know, right? Let's say certain web series, etc. But participate after the session is over. You do whatever you want to do. So come back to the discussion here. The capital account is associated with the transactions which are leading to, right, assets and liabilities. For example, a foreign company will bring money into India, invest in stock market. Those are assets. Indian company goes to the foreign market, takes a loan from the foreign market. That's a liability. A foreign company will bring dollars into India, set up a company in India. That's an asset. So I hope you understand the transactions associated with the assets and liabilities are listed under the capital account. Whereas the transactions which are associated with incomes, the transactions which are associated with, right, incomes and, right, let's say other invisibles, I'll come to this. Other invisibles are recorded in the current account. The incomes and other invisibles are recorded in the current account. Now I said incomes and other invisibles. What do you mean by this? Listen to me very carefully. If India will export, India will earn income. Correct? India will earn income. If India will import, it will pay. It is income for somebody. Right? We will pay for imports, we will earn for exports. But both of the transaction are nothing but incomes. One is earned by someone else, right? The other one is earned by us. So incomes. But I said one more term, invisibles. I used one more term, invisibles. What do you mean by invisibles? You tell me now. Services. Services. India will export services, earn money. India will import services, pay money. But can I simply say services are invisibles for us? Yes or no? Services are invisibles for us. Invisible means you can't see. Goods you can touch, you can feel. Invisibles are the ones you can't see. Services are an example. Remittances. Tell me now, remittances. Remittances are again invisibles. That is simply the money will be transferred from one account, foreign market, into, right, let's say the domestic account. Money will be simply transferred. You have invested in USA's stock market. You will earn interest on it. Again, right, invisibles. So, the incomes and invisibles are recorded in the current account. Assets and liabilities are recorded in the capital account. And who will prepare this, right? Let's say the record, it is prepared by Reserve Bank of India. RBI prepares the balance of payments. And I've shown you two sides of the balance of payment. In one side, they will simply record all the dollars which are coming into India. Income sources, all the dollars that will come into India. And the other side, all the dollars which will flow out of India will be recorded, and that is expenditure. That is essentially the expenditure side. Is it okay? Please do let me know. Is the concept okay so far? But sir, then income is also invisible. My dear, exports, goods are there. Right? Goods are visibles. You are earning income, but that is associated with goods. I am using the term goods. They will use the term merchandise. They will simply use the term merchandise. Right? Merchandise are visible. Services are invisible. That's the reason services, right? Basically, I've kept it under the invisibles. Right? You have invested in the foreign market. You will earn interest on it. Invisible. Right? So, others are invisible. Merchandises are visible. Done? Everybody is okay so far, so good? Now, please have a look at the table. Please have a look at the table. Another table. Do not memorize anything. I hope you understand. Please do not waste your time. Do not memorize anything here. Why? This is the kind of table which is published by Reserve Bank of India. Reserve Bank of India. What is the information? What is the information you need to derive? Simple terminologies. What are the kind of terminologies? You will come across one term, balance of trade. Have a look at this. You will come across one term, balance of trade. You will come across one more term, that is current account. Current account, either surplus or deficit. I'll go one after the other. Please listen to me carefully. You will also come across the whole balance of a payment, either surplus or deficit. What is the meaning of each of the terminologies? Let's go one after the other. Let me start with the first one, balance of trade. Balance of trade. Right, what is balance of trade? India will export goods and services. India will import goods and services. India will export, India will import. Now listen to me carefully. Instead of using the term goods, they will use the term merchandise. Merchandise. In the context of merchandise, India generally imports more compared to exports. Is the term okay with all of you? In the context of merchandise, India imports more compared to how much it exports. Meaning what? I will import, I will have to pay $100. I export, I get $80. So there is a deficit here. Please remember, there is a deficit, right? That is a balance of trade deficit. In the context of merchandise, India has a trade deficit. Everybody is clear regarding this? Do let me know. What about services? In the context of services, again the data is there here. You can have a look at this. Don't memorize this. Please do not memorize. In the context of services, India's value of exports is greater than value of imports. In the context of services, we are exporting more value compared to, right, the value of imports. So when you talk about balance of trade, in case of services, we enjoy a surplus. We enjoy a surplus, meaning what? I will import services, I will pay $50. I will export services, I will get $200. So how much extra dollars, surplus dollars have I received? I have received a surplus of $150. So everybody is okay with my statement? Please do let me know. I want answer from everybody. Otherwise, right, I'll stop the session. Again on a lighter note. Because a lot of you will simply say, great, sir, stop it. Friday evening, I'm already outside. I'm in a different zone altogether. Stop the session. I don't want anybody to learn anything. Argument is simple. In merchandise, deficit is there. In services, surplus is there. But overall, what is the situation? Overall, what is the situation? Right? Overall, the merchandise plus services, India generally experiences a deficit. Is the statement clear to all of you? If you take care of all of this, that is the goods, that is merchandise plus services, what is the situation for India? India generally experiences a deficit in the context of the trade. Everybody is okay? Now come to the current account. Come to the current account. In the context of current account, what is the idea? You can have current account surplus, you can have current account deficit. That is, you take the sum total of all the transactions under revenue side, only current account. You take the sum total of all the transactions on the expenditure side. If the expenditure is higher compared to revenue, let's say expenditure is $150 billion and the revenue is $100 billion. Can I simply say, in this case, there is a deficit of $50 billion. Correct? There is a deficit of $50 billion. Again, just to make you easily understand, I am using simple numbers. What is the exact number? You also don't have to be worried. Reason being, from one month to the next month, numbers will change. From one quarter to the next quarter, numbers will change. Numbers do not remain constant. That's the reason, don't waste your time. But traditionally, what has happened in India? Traditionally, do not use the term always, but most of the times, India experiences current account deficit. Is it okay? I'll repeat the statement. Not always. Right? Don't use the term always. Why? During pandemic, we experienced current account surplus. Very recently, we have experienced current account surplus. But generally, it is a deficit. Right? Most of the times, it is current account deficit for India. Everybody is okay with the concept of a current account deficit, current account surplus. Now, come to the whole balance of payment. Come to the concept of whole balance of payment. That is, take the whole balance of payment. What is the situation? Take the sum total of revenue, current plus capital. Take the sum total of all the transactions under the expenditure, current plus capital. Get the sum total. In the whole balance of payment, how much dollars are coming into India? How many dollars are going out of India? Take all the transactions, get the sum total on both the sides. If revenue is greater than the expenditure, that is called as balance of payment surplus. Is it okay? I'll repeat the statement. If the total revenue side is greater compared to the expenditure side, that is balance of payment surplus. And if expenditure side is greater than the revenue side, that is called as balance of payment deficit. BOP surplus, BOP deficit. Now, before I go forward, certain more terminologies here. Certain important terminologies. Right? What are the important terminologies? There is a term called as autonomous transactions. Remember this. There is a term called as autonomous transaction, and there is one more term called as accommodating transaction. Accommodating transaction. Autonomous and accommodating. What is the meaning of autonomous? Any of these transactions which are economic in nature. What do you mean by economic in nature? Any of these transactions which are done for business purposes, for profitability purposes, for certain interest purposes, those are called as autonomous transactions. Is everybody okay with my statement here? Do let me know. Right? Whatever transactions are there, if these transactions are basically done for profitability, for interest purposes, for economic reasons, these are called as autonomous transaction. And most of the transactions are autonomous in nature. Is the point clear to all of you? Most of these transactions are autonomous in nature. For example, you tell me, export, import. Don't you think that is done for profitability purposes? Foreign investment coming into India, foreign investment flowing out of India, FPI, FDI, all of these are done for economic purposes. No charity, nothing, autonomous transaction. But imagine, listen to me carefully. Imagine there is a BOP deficit. Right? Listen to me carefully. Imagine there is a BOP deficit. What is the meaning of BOP deficit? The sum total of income, I'll write it in a separate slide so that you understand. The sum total of income, right? The income side, let's say, is $150 billion. The sum total on the revenue side is $150 billion. And the sum total of all the transactions under the expenditure side are, let's say, $200 billion. What does it mean? Can I simply say, here is a country which is experiencing BOP deficit? Correct? Here is a country which is experiencing BOP deficit. How much? We are experiencing a BOP deficit of $50 billion. Now, question arises, from where will you get this $50 billion? Right? Let's say this is India. Imagine this is India. From where will you get this $50 billion? Can you simply say, sir, printing machines are there, color is also there, paper is also there, we will print dollars and supply it? Not acceptable. You do not have the right to print dollars. Forget about dollars. You do not have the right to print Indian rupees only. The argument is simple. From where will you get these, right? Let's say dollars. One method is essentially you will use the dollars which are part of forex reserves. Who maintains forex reserves? Please do let me know. Who maintains forex reserves? Which authority maintains forex reserves in India? Reserve Bank of India. So understand the logic here. Whenever there is a deficit, we take the money from the forex reserve, that is the dollars which are there in the forex reserves will be supplied, will be sold, rupees will be purchased. And if there is a vice versa, that is excess dollars are present in the economy, what does RBI do? RBI will sell rupees, purchase dollars. So please remember this. One of the functions of RBI is to maintain forex reserves. In addition to this, there is one more word, one more terminology, the sale of official reserves. Suddenly UPSC will ask you this question. The sale of official reserves. Who will conduct the sale of official reserves? It is Reserve Bank of India. It is the Reserve Bank of India. Now listen to me carefully. If there is a surplus, RBI will purchase. If there is a deficit, RBI will supply. But what if I say, this is also very important now. What if I say you require additional $50 billion to pay to the rest of the world? The forex reserves, there are only $20 billion. Think of this. You need $50 billion. But how many dollars we have in the forex reserves? We have only $20 billion. This situation where you're about to exhaust your forex reserves is called as a BOP crisis. Is the terminology okay with all of you? Do let me know. This is a situation where you're about to exhaust. Exhaust means finish. You're about to utilize all of your dollars which are present in the forex reserves. After this, no more dollars with you. This is called as BOP crisis. So, any country that has faced a BOP crisis, India faced a BOP crisis back in 1991. India faced BOP crisis. The last time India faced a BOP crisis was in 1991. And whenever any country faces BOP crisis, what do? They basically approach IMF. They basically approach IMF, International Monetary Fund. Did we approach IMF? Yes. We approached IMF 1991. We took loans. We repaid the loans. In recent, let's say years, in the recent times, any country has approached IMF because of the issue of BOP crisis? Yes. Sri Lanka, Bangladesh, our best friend, again, in joke sense, in a comical sense, Pakistan. Don't simply take that particular statement out of context, take a video and basically blast me in all the platforms saying that, see, this fellow says, this kind of a statement. So I hope you understand, So multiple countries in recent times also have approached IMF because they were facing the issue of BOP crisis. Everybody is okay? That everybody is okay with the discussion so far? So these are certain very important points, important concepts associated with the idea of a exchange rate as well as balance of payments. Let's solve certain questions. Then whatever doubts you have, I will address those particular doubts. Let's solve certain questions. Start now. How many of the following are part of autonomous transactions of balance of payments? Okay, before you solve this question, there is one more term, Let me explain that other term also. Accommodating. Let me explain the accommodating also, then we can solve the question. Autonomous means what? Economic transactions for interest purposes, for profit purposes, Those which will happen naturally without any regards, without any focus on what is happening to BOP. Why are you exporting? You are exporting because you want to earn money. Are you worried about what is happening in BOP? No, you are not worried. Your focus is on earning. So whatever be the status of BOP, you are independent of it. Your transactions are independent. They are not connected to what is happening in the BOP. But imagine if there is a BOP deficit. Imagine there is a BOP deficit. Now, don't you think RBI will conduct the sale of forex reserves? Correct? If there is a BOP deficit, will RBI conduct the sale of forex reserves? Why? Because there is a deficit. Here is a transaction which is being conducted because there is an imbalance in the BOP. It is dependent on the situation of the BOP. These are called as accommodating transaction. Everybody able to understand this? Do let me know. I'll give you one more example. I said if there's a BOP crisis, you will go to IMF, take a loan from IMF. Now tell me, why did you take a loan from IMF? Don't you think you want to address the problem in the BOP? That's the reason you took the loan. Correct? Because there is a problem in the BOP, you want to address that problem. It is dependent on the situation of BOP. Hence, you took a loan. Hence, you use the forex reserves. These transactions are called as accommodating. Accommodating simply means there is some problem in the BOP. There is some issue in the BOP. You want to address that particular issue. Those transactions are called as accommodating transaction. Done. Now solve the question. Let's solve the question. How many of the following are part of autonomous transactions of balance of payments? Imports, exports, FDI. Yes, look at the last one. Indian government borrowing from IMF. Tell me, why does government of India borrow from IMF? Just because government of India doesn't have anything to do. Just because government of India simply says loans are there, let's take a loan. No. If you're taking a loan from IMF, it is associated with the BOP crisis. It is because there is a BOP crisis. There is issue in the balance of payments. That's the reason you are going to IMF. Otherwise, there is no need to go to IMF. Right? So, 1, 2, 3 are correct. Right option will be option D. Right? These are the transactions which are accommodating in nature. Sorry, the autonomous in nature. Next question. Which of the following is or are likely to reduce CAD? CAD stands for current account deficit. CAD stands for current account deficit. Let's start. Export bans, promotion of healthcare tourism. Third one, increasing foreign investments in Indian stock market. Be careful. Please be very careful. Let's start. Export bans. Point number 1. Import and export, part of current account. Correct, part of current account. But if government will impose export bans, which basically means what? You will not be able to export. If you are not able to export, inflow of dollars will go down. Correct? Inflow of dollars will go down. So now tell me, if the inflow of dollars will go down, current account deficit will go down or current account deficit will widen? Let me know. If inflow of dollars will go down, will the CAD reduce or increase? CAD will start increasing. Everybody is able to understand? CAD will start increasing. Why? Until now you exported, got certain income. Now you are not allowed to export, which means no income. So the CAD will not reduce, rather will increase. So first one, incorrect. Promotion of healthcare tourism. Promotion of healthcare tourism. What is the importance of this statement? If government of India will promote healthcare tourism, lot of patients from rest of the world will come to India. They will spend money in India, which basically means dollars are coming in, services are going out. Simple. Dollars are coming in, services are exported. So when the dollars will come, right, essentially it will help in reducing the current account deficit. Second one, correct. Third one, increasing foreign investment in Indian stock market. Now tell me, if a foreign investor will invest in the stock market, don't you think the assets held by the foreign investor will go upwards? Dollars will come, no doubt. Because of the third one, dollar will come into India. But you tell me, the dollars which will be used to purchase the shares, will they not increase the assets held by the foreign investor? And if it is associated with the assets, will it be part of current account? Will this be part of current account? No, this will not be part of current account. Somebody says yes. My dear, right? No, it will not be part of current account. It will be part of capital account. It will be part of capital, not current account. So third one, in either case, it is not part of current account transaction. So how many of them are correct? Second one is correct. Right option is option A. a lot of you have made a mistake here. A lot of you have made a mistake because you are not looking at whether it is a part of capital, current, it is going to widen or reduce the current account deficit. Done? Everybody is okay? So now if you have got any kind of questions or doubts or confusion regarding whatever I have discussed, please do let me know. Any kinds of doubts, confusion, etc. regarding whatever I have discussed, people are asking doubts in the middle of the session. It is the time to ask the doubts. I'll address your doubts. Do let me know. Any doubts or confusion regarding whatever I have discussed? No? Okay. So since nobody is asking any kind of doubts, BOP related to only current or both capital account? My dear, balance of payment has both the accounts. Balance of payment has both the accounts, current and capital. So BOP surplus or BOP deficit, you will have to take the sum total of all the transactions. Sum total of all the transactions in the current capital account. Okay? Tejpal Singh, sir, your sessions are enough for economy syllabus or do we need to read any book? My dear, please read. Please read. And keep on accumulating knowledge. Keep on accumulating knowledge. And by the way, these were the sessions that I had planned for you under the initiative of Fundamentals of Indian Economy. We started from Monday. Today is Friday. So with this, I'm going to wind up this particular initiative now. In the future, right, I might be planning for some other initiative. But meanwhile, listen to me carefully. Meanwhile, download the handouts, download the PPT, and more importantly, please keep on updating current affairs. Please keep on updating current affairs. How can you do that? Are you supposed to read multiple newspapers? Can you have so much of time, etc.? For that reason itself, I have launched a new initiative by the name of Economy this week. Every week, one video we are uploading, hardly 40 to 50 minutes. Right, please have a look at the articles. I'm covering different articles from different newspapers. Right, I'm making it easier for you to update current affairs. Do not miss out on this opportunity. Please attend the session. Go to my Telegram channel, PPT and the handout. The summary of the articles that I've covered will be present there. Download, use it for revision. Okay, done. Tejpal Singh, my dear, don't worry. Don't worry. You don't have to say sorry. Right? I told you, I never shout or scold anybody for any kind of doubts. I'll simply say, wait for the end of the session. I'll address it. You don't have to be sorry for that. Aman Barnwal, please repeat the last point on exports related to BOP. Which point, my dear? Which point? Was it related to question? Export bans. Okay, let's say you're exporting $10 worth of goods and you're importing, let's say, $20 worth of goods. Right now, how much is the deficit? Right now, how much is the deficit? $10. Now, if the government will ban the exports, even these $10 you will not get. As a result of this, the deficit will widen to $20. Deficit doesn't come down, deficit widens. Okay. Sir, how to collect a CI article in today's newspaper? My dear, I hope you understand. You'll have to keep on reading the newspaper articles. Overnight, you will not get the information. Please keep on reading the articles. That is how you build the, let's say, the repository of current affairs or the knowledge associated with current affairs. Done then. So, let me stop the discussion. Here. Before I wind up the session, again I reiterate, tomorrow and day after tomorrow, we are conducting UPSC Summit. For you people, please do join the sessions live. Use the link for registration. The link is provided in the description below. If you like this initiative, do not forget to hit the like button and do not forget to join our YouTube channel if you are yet to join. And again, I reiterate, if you're finding the Indian economic current affairs difficult to understand, comprehend, or read from different newspapers, all you need to do is weekly sessions are available, right? Watch the videos, download the notes and revise. So that's it from my side. See you again, right? Whenever I create a new initiative, whenever I launch a new initiative. Till then, keep on watching at the Economy This Week initiative. That's it. Take care. Have a great day. See you in the next session.